In your money this week, the Iran conflict continues, which has impacted markets. Yields are up, stocks are down, although the VIX hasn't really spiked yet, which I'll discuss with Andrew. The Fed met this week and kept rates steady. And Andrew and I are going to answer a question that if you are concerned about a recession, how should you prepare? But first, Andrew, the gang is back.
We're back, baby.
We're back. Between your comment to me a couple of weeks ago that it looked like I was giving a presidential address, just staring straight into the camera, and then Janine asking last week why I was still recording these by myself, I figured even I can take these hints. We need Andrew back.
I don't know about that, and I'm displaced right now. The office cleaners are here, so the conference room is getting wiped down. So if you hear a vacuum in the background, rest assured it is not me.
I think our loyal listeners have come to expect extremely high production value, so they're just going
Yeah,
to have to grind it out for one
they'll
week.
adapt.
They'll
They'll
adapt.
adapt.
Yeah. So the Fed, as I talked about, kept rates steady. But before diving into that, um, just the market moves. So the S&P is down 6.5% from its high on January 28th. That's about 5% down since the conflict started. So the conflict started a month after that. The Russell 2000 small caps are down just under 10% from its high. Again, 6% since the conflict started. The international markets have had a different trajectory. They kept going up in that month between January 28th and February 27th or 28th when the conflict started. So developed international is down 10.5% from its high, all of which I think is attributable to the time period of this conflict. Emerging markets, same story, although they're down more at about 15%. So, the first thing I was going to ask you is, do you think at some point the Trump administration is just going to go out there and tout the relative investment returns of these moves that they've made?
I would not be shocked by that at all. I mean, that's very much in the playbook. I would not be surprised by that. I'm actually kind of fascinated that the market reaction in and of itself, even just isolated here in the U.S., looking at the S&P 500, has not warranted more discussion
Right.
from him.
Yeah.
And I don't know what he would say. I mean, you certainly would like to think that wouldn't dictate mission critical actions and decision making. But I am surprised there hasn't been a more upfront message on that line.
Have you seen anything? I tend to go as an asset allocator, US, large cap, small cap, developed international, emerging markets, bonds. Have you guys seen anything sector by sector or name by name that's jumped out at you?
I think the biggest thing, and we talked about it some on our podcast, the Morning Market Briefing. Check it out anywhere you listen to podcasts. But we talked about it some this week. And I think the biggest thing is there just seems to be a complete and utter apathy from investors. I think people are fatigued. I think they're worn out. Companies have come out, even in instances in which they reported, frankly, pretty surprising results. People have just said, whatever. I think of one example that comes to mind this week, and you know this about me, but your audience may not. I hate Lululemon stock. I hate their company, but they came out and had relatively decent things to say, and the stock got beat up. Uh, it's kind of interesting to me when you think about um, just the reaction from people. People just don't seem to want to invest, and that's really butting heads with what we felt like was an awful lot of cash on the sidelines early at the beginning of this year. And I think there's just not a lot of willing buyers.
But at the same time, the market's not really in panic mode
It's
either.
not.
I mean,
It's certainly not. And the VIX is perhaps the best indicator of that. I mean, hovering
yeah,
very stable at 25, which is maybe elevated relative to the historical. But I do think there's a read through. I think some of the smarter minds think that this war is potentially, or the conflict, whatever we're calling this thing, is closer to on schedule. I'm using air quotes if you're listening to audio, than maybe people assume. And I'm of that school of thought. And that doesn't mean I'm one of the smarter people, but that's my general read on things.
yeah. So diving into the VIX, it's up today. It's close to 25, 26. By comparison, I looked just over a year ago, right after Tariff Liberation Day, it peaked at 57.
Yeah.
So, the market is a little bit sanguine, it seems like, which I do want to ask you about. But just touching base real quick on your thought, if people are listening, they can't see the air quotes. This is definitely something to watch, the two of us. You do
Yes.
not want
Oh,
to
you
just
got
listen to
to.
this in the background. You
Yeah.
mic on, camera on, video on,
Yeah.
like
We
dive into the
have
whole experience.
we have voices for YouTube, as they say.
So I guess I was going to ask you different way of looking at it because you mentioned, people don't want to invest. You used Lululemon as an example. I talked about the VIX. Is it possible that the market is too complacent? There's a feeling that that's out there that, as soon as whatever this is wraps up, oil starts moving, hey, we're kind of off to the races. And it feels like the market being down 6% since when this started, globally stocks down about 7% since when this started. Is it possible that the market is just too complacent and the base case is that this thing is going to wind down pretty quickly, and the surprise to the market will be if it doesn't, and that'll be painful to investors?
I think there's a chance of that. The point I would bring up counter to that is both in survey data as well as just everyday conversations, talking with clients, which you're not doing right now because you're on a sabbatical, but I'm still doing. Not to brag, still doing the hard work. But I would say there's a real disconnect, and we have great clients, and we try to give them as many resources as possible. But I think the average client actually thinks returns year to date are significantly worse. They're very downbeat about them. So I'm hesitant to say that it's just complacency. I think it's more a little bit of a spirit of kind of resignation in some cases, if that makes sense.
It does make sense. Yeah. So I just following up then on my own thought is I do want listeners, investors, clients, people we care about not to be shocked if we get a much bigger pullback. And by not be shocked, mean just it's one of those things that happens. The market does it. If it doesn't, don't overreact just because it seems to have taken the market by surprise to get us there. We don't know. I could see this thing, declare victory, move on, oil moves, we're off to the races. I could see, it's Iran. Nobody's been able to do it for 40 years, 50 years, whatever it is.
Yeah.
Another conflict that grinds out, no easy exits, and, things get worse before they get better. But
Yeah.
I do think people should just stick to the long-term plan and
Yeah.
don't get rattled by what happens or try to time this thing. Fixed income. So the 10 years moved. It was just under 4 before this started to approaching 4.4 now. Would you consider that a pretty decent move?
Yeah, very significant. Case in point, I mean, we are transitioning even within the fixed income portion of an allocation within a portfolio. We're taking advantage of those longer rates. I think when you and I first did the call here, it felt like the 10 year should hover around 420, and then it kind of evolved and felt like, hey, maybe 410 is more of the baseline. When we started moving, to 430 and upwards, we really view that as opportunistic because it is a significant move. Are we going to chase a move from 410 to 415? Probably not in reality, but this kind of move, I do think it's meaningful.
Meaningful in that it's presenting an opportunity to get a more attractive yield for not a
Yeah,
lot of duration risk.
absolutely.
Okay.
Exactly.
Do you feel like that move is signaling a concern to the economy and inflation that people should factor in?
Um, Possibly, I think more than anything, it is signaling general uncertainty in the marketplace, and I think it is signaling an ongoing belief that okay, maybe we are not going to get the rate movement and the rate intervention from the Fed that those who are most prone to want to see cuts or want to see, and I think it's a little bit of that.
It's flowed through to mortgage rates. I think right now on average are about 6.5,
Yeah.
whereas they had briefly dipped below 6. So, getting to that, then the Fed. So the Fed met this week. They kept rates steady. You guys on the morning market briefing are not shy about expressing
Our
your views
opinions.
about the Fed in particular, which I think they've made for an easy target over the last few years. But so they kept rates steady. And on the one hand, read economic activities expanding at a solid pace, job gains not so great, inflation somewhat elevated, uncertainties up because of the Iran conflict, the dot plot projecting maybe one cut this year. But then they also basically said, or Powell basically said, maybe ignore the dot plot, ignore the projections.
Yes.
We have to wait and see what's going to happen in the Middle East. And so generally seems like maybe they're saying they're not in a rush to cut. They're worried about oil prices, inflation above their target. They haven't seen a bad enough labor market yet, but they're also just like the rest of us. We don't know how this is going to play out, so wait and see. Is that what frustrates you guys about the Fed? That
It
they can't,
is.
okay.
It is, and I think they have an unbelievable scapegoat right now in the form of the war. This is the umpteenth scapegoat they've had over the last 4 or 5 years that can cloud their judgment and either put them in a spot in which they make phenomenally wild and inaccurate expectations of insert economic data point here, or they say we can't really be confident in these predictions that we have made because of this uncertainty. And the reality is, the war may fade. There will be more uncertainty. I think in this technology, instant access, short news cycle reality that we live in, which is not slowing down, the cause for uncertainty is only going to increase. And if you're incapable of finding a medium, and maybe the dot plot's not the way to do it, but if you're incapable of finding a medium that says, hey, here's what we actually think will happen and you should believe us, I don't know why you are setting monetary policy for the largest economy in the world. Like that really, really bugs me. I think it bugs everybody here. And simultaneously also missing key data points. I mean, they talk about the employment picture. If you look at the chart of the number of people employed in the United States as a percentage of the population, it is not a chart, Sammy, and Tom made this point earlier this week on our call. You would never show that chart to somebody and say, look at your account performance, it's doing well. And the reason you wouldn't is it's going down and to the right. Like it is a horrible chart. If you flipped it upside down, I would buy that the employment picture is quite stable, but it's not. And they just completely ignore that while simultaneously saying we don't have any idea what's going to happen.
So I think that we don't have any idea what's going to happen. I give them a little bit more leeway on because we tell our clients all the time nobody can forecast the economy, and I would include the Fed in nobody. But I do agree with you. They have anticipated, bad outcomes that didn't necessarily flow through, right?
Yep.
The inflation that they were worried about with tariffs, I don't think it materialized nearly to
No.
the extent um, that it did. But I guess I would say,
Which
so
what
you,
bugs me by that, going back a year, Sammy, sorry to cut you off,
yeah,
but
no,
like
that's fine.
that was easy to digest and know. Like we did an analysis for our clients in which we talked about a Ford F-150, which really resonates with people down here in the South. And we talked about even the shocking level of tariffs that came out on Liberation Day. Here is the dollar impact of the cost of a $65,000 truck. And it was relatively negligible. I don't have the number in front of me, but if you couldn't afford it at that price, you couldn't afford it at 65,000.
Yeah.
And that was known then and it's now realized.
So you would like to see lower rates because of the labor market.
Yep. Yep.
And I understand there are constant, you know, emergencies or issues, and uncertainty is just part of the game. It reminds me of a time. It's a cartoon I saw decades ago that's timely again today, and it was this investor who said he wasn't going to invest until there was peace in the Middle East. And right, it was like 5 decades ago or whatever. And, the guy's been waiting since like 1967, I think was the point of the cartoon. Which I guess, to my point, they are in a tough spot with this war and the impact of oil on the inflation picture.
They are, but my argument would be if we are one, there's so many economic measures in which they strip out the energy costs that they do look at. And the other piece is we could at least extrapolate oil staying right here and run models on what that does to inflation right now. And we could at least present both sides. I thought Home Depot, which is in the interest of transparency, that's a company that we own pretty widely here for our clients. Home Depot late last year did an excellent job of giving guidance in which they basically said, here's our base case scenario if things remain the same, and here's what we expect if housing picks up to what we consider to be more normalized. And it was two totally different sets of numbers. I think what we are getting instead of that from the Federal Reserve, as an example, is just 11 different opinions on the unknown and not a lot of what about this or that.
Yeah, so rates lower to support the labor market, to support the economy. And on the episode I did last week without you, GDP came in at 0.7%, right? Which supports that outlook.
Yep. Yeah.
Yeah. All right.
I mean, I think it's time to, I don't think they're going to budge. And I think, with Powell seemingly staying on, I also think some people were expecting a real shakeup on the Fed this year, and I just don't think we're going to get it, even though, his chairmanship may expire, but there's not going to be the headcount swing that maybe some were expecting.
Well, that case they initiated against him really backfired
Oh
because
yeah.
now he's staying longer.
He's standing in. I think
Yeah.
it puts Trump in the would you like him off the Fed or would you like to try to get him in jail
Yeah, I think
standpoint.
that that is a strategy that would have got him kicked off his own apprentice show, basically.
Yes. Yeah.
Like,
Yeah. Yeah.
hey, watch
You made
this.
the wrong bet.
I'm gonna guarantee this guy stays around longer.
Yeah, exactly.
All right, so I had a question for you because it's been asked to me, and I have talked to a few folks. You're right, I am halfway through a sabbatical, which has been amazing. But if someone is concerned that what is going on right now would tip the scales and put us into a recession, how would you advise them to prepare their portfolio and their personal finances, since we're also advisors, not just money
Yep.
managers?
Yeah, I would start on the personal finance side. Number one, sharpen the resume. Get that thing looking tight. Be thinking about it. And not only that, take it one step further and say, okay, what are my highest compensated skills, my most unique and most useful skills? And where could I apply those in a different industry? If you are in an industry that is potentially facing a real spending pullback, potentially layoffs, is there a job in an area that might be more sheltered? And I don't have a specific example of this because I would have to know what someone is doing. But is there an area where you can start thinking about, okay, how do I get to an industry where there's a little bit more protection? Save cash, avoid the major purchases. Cash is going to be invaluable in the event that you are personally impacted by the employment picture. And on the portfolio side, it's my biggest caution to people is to don't overthink it and don't overdo it. You want to prioritize liquidity. I would say if you are fearful of this, this is an excellent time to be restructuring your portfolio. Even if you just think of the equity box, restructure your portfolio in a way that does two things. Number one, generate some tax flexibility. What can you sell at a loss? What can you sell at a gain so that you're tax neutral and at a minimum resetting your cost basis, but potentially avoiding a spot in which you need to get money out for personal reasons and you're paying a massive tax bill. You can do those things right now. So be thinking about those. Be really prioritizing short-term, highly liquid investments, specifically on the fixed income side. We've talked a lot about the 10-year that, again, we're seeing 4.3 and even 4.5 on the 20-year. Hey, you probably don't want to be in those. Let's be thinking a little bit more about, okay, what can I get to quickly? And traditionally staples have done well on the equity side, healthcare, utilities, all these things have done well. The problem and the challenge there, if you get too cute with it, is by the time you realize that we're coming into a recession, everyone else probably has. And we've seen it, especially in the utility sector, time and time again, that thing starts moving and ramping up, whether it's over people just wanting more income and the rate environment is low. Those industries are really responsive to demand in terms of their pricing. But my biggest piece of caution is don't do anything that's damaging now and irreversible in the future. Don't realize gains just to make this happen. Don't saddle yourself with a big tax bill. Don't do something that's going to be hard to come out of, because the reality is, even from a definitional standpoint, we don't know we're in a recession until we're already in it.
Yeah,
And
or
very
past
few
it,
people
right?
and very few people are successful at timing those things.
Yeah.
So don't do anything that really shakes things up. Candidly, and we talk about crypto, I feel like every call, but I would be dumping Bitcoin because it is a primary source of liquidity for people, and most of the people holding those do not have a robust investment thesis, and that's why you see downward movements, often steep downward movements, not like what we've seen the last couple of weeks, but steep downward movements for traditional markets often lead to even more selling off in the crypto space.
I shared a blog post at the beginning of this week. Crypto, well, actually, it was Bitcoin, is up 67% annualized over the last 10 years, and about half of the token holders are underwater.
Yep,
So
it's amazing.
it's amazing when you consider it. Check out the post if you're interested. So there's some overlap on our list. One thing I hadn't thought about was the job and the labor front, and I would just extend that to say in general, regardless of the environment, don't start networking when you need it. Don't start becoming aware of what is out there in terms of career possibilities and career moves when you need it, when it's too late. I always lament people who are looking for help or looking to make a move and they're doing it way too late and
Out
they
of
haven't laid the
desperation.
yeah and they haven't laid the groundwork of just being active, networking, getting to know people, getting to know the space, getting to know other spaces. So I love that suggestion, and I would just extend it overall, just be more active in terms of understanding what's out there and meeting people. On the portfolio side, that was one of the things I was going to say. If you feel like you don't have enough of a rainy day fund, free up the cash. We're off the highs, but again, not that much, 7%
No,
for global stocks. So it's not as if you're selling at a low point, and the market's been on a very strong run leading up to this, So if you feel like you don't have enough of a rainy day fund, to your point, do it, but do it in a tax aware fashion. I would say generally during times of market distress, use it as an opportunity for tax loss selling. But again, with a 7% sell off, I don't think that those opportunities have really
no.
presented themselves yet. And the only other couple things I had on terms of this relates to debt. If you own floating rate debt or you have high interest debt, I'd look at that, consider whether it made sense to pay off or refinance into something at a fixed lower rate. And if you're buying a house, I would compare mortgage rates. I've been saying that for the last few years as the mortgage market has changed. But with rates higher, you definitely need to comparison shop and do the math or have somebody do the math with you in terms of how long you're going to own the property if an adjustable rate is beneficial.
There's real variability there when we're at a elevated base rate.
And I think finally, you need to listen to people you know and trust who put out entertaining content. So check out the morning market briefing if you
Let's
haven't
go.
already. Check out the Boston Advisor YouTube page and the bostonadvisor.com. Like this video, subscribe to the channel, and if you do have questions, reach out and we'll answer them in future episodes.
Awesome. Thanks, Sammy.
Thanks, buddy. Have a great weekend.
You too.